Welcome to a live video directly from Ho Chi Minh City in Vietnam. And I am with a very special guest today, someone that I was impatient to reconnect with, Paul Langham. So, Paul, we'll just wait a couple seconds to see that it's working fine and stuff. But
Yeah.
I'll let you
Okay,
introduce
no
yourself in
problem.
a second.
Yeah. Okay. Hi, Etienne. Thank you very much for having me on the podcast or the Hangout. I suppose this one is. It's a Hangout. I had a previous conversation with you on a podcast, which was great fun. Great to connect with some of your guys, as I was saying in the chat before we started. There were some great guys which came off your side. Very impressed with what you're doing. First thing I would say to anybody who's out there, take a look at Etienne because influential mover in Forex in terms of the fact young guy trades, moves around the world. It's the lifestyle that everybody is actually looking for. So take a leaf out of this guy's book and give him a good big thank you for the site that he's running. So great. Thanks very much for inviting me anyway.
Nice, wonderful. So it's going to be kind of a mix of lesson plus Q&A today. We'll try to answer your question as much as possible.
Yeah.
And I know you guys have a lot of questions about price action, and Paul is I would say, expert at price action. He knows like pretty much everything there is to know to make money, and that's going to be perfect. It's all we need. So we have a couple of people joining us right now. Andre, Daya, Mashudu, welcome guys, welcome. If you have any questions, just comment below at any point. We'll make sure to answer them. I want Paul to maybe just talk a little bit about yourself and the kind of trading you're doing these days, and a little bit of your past as well, because it's really interesting. I know you have a big background, but explain people what you've been doing so far.
Yeah, okay. So as I explained on the podcast, I started actually very young in this game in terms of the fact that I was actually one of these private schools in the UK where there wasn't much to do, locked away, sports, academic stuff, and a bit of music as well. We got interested with one of the maths teachers who introduced us to game theory. When you're 14, 15 years old, so I think you decide that this might be a great way to make money. So we tried everything from beating casinos to horse racing and the rest of it, and it was a gradual movement towards financial markets, which obviously are a little bit easier than the two former topics, because the odds are not necessarily always fixed in the direction of the market maker. And I actually started to work in the city in London, come from the UK, obviously. Been over in Belgium or in the Benelux for 30 years now, over 30 years now, which is a long time. Originally started in the city, got a little bit caught up in the crash of '87. That's what's one of the reasons that initiated my move over to the European continent. So I had some experience of the old-fashioned way, I would say, before the Big Bang, 1987. All of the floor traders, the commodity houses, a little bit slower in terms of the way prices were traded, or instruments were traded rather. And at the time when I started, it was bits of paper. So I had actually a seminar in London at the end of November, and I was explaining to the guys it was effectively a position keeper, which meant the guy next to me was on the phone, mostly to places like Hong Kong and New York, and would just throw a piece of paper over the top of the desk at me, and I had to keep the positions of the day, and at the end of the day we had to balance the thing up, net it all out, and quite often there's a lot of pieces of paper on the floor, some of it in the bin, all sorts of things. We had to work all that out. That's how it all really started. As I said, it's quite a long time ago. Things have moved on obviously tremendously since then, and I think one of the big things is the automation which has taken place, to the rise of computers within inside the banks. I mean, it was a very manual process then. Been involved in that, obviously. What I'm actually been doing recently is some of these robo advisors. I don't know if you know any of these companies like Nutmeg, people like that in the UK. So this is a type of trying to get rid of actually fund managers. That's what they're trying to do. So the computer actually decides what it wants to buy for you, but obviously based on the instructions which are given by the fund managers. We've yet to see whether those beat the fund managers in the long run. At the moment, they're doing very, very well. But the specialization obviously is in FX, and it's been in FX for many, many years now. So I started 2008 after the big crash, the housing crash. Started my site Exact Trading, YouTube videos as well, and I've been trying to help people since then. Helped quite a few people. Some people gone on to be successful. Actually, we have one guy who started his own private equity fund, which is quite satisfying. He sailed off into the he sailed off into the wind. He's got his private equity fund. Got other people who I just get emails out of the blue sometimes. This guy said, because I post videos actually in the morning and the evening every day, just free of charge for people, just to help them and also to help myself. I get down to the bank, to the office, just to see what the market's done. It makes me focus a little bit. So that's quite a lot of hard work, but it helps me to focus. I know what the market's doing before I get there because I'm forced to do it. I force myself to do it. That helps. And I do get emails from people who say they've just viewed my videos and they're making money off that. Not everybody will. It depends on how you trade, your personality, what sort of leverage you're using, how capitalized you are, that type of thing. So, but that's just a very, very brief overview of what I've been doing. But I'm purely a price action trader. I had a couple of articles. I had an article published in Stocks and Commodities magazine not long ago. And I'm actually in the middle of writing a book as well at the moment, but I have to say it's not going particularly fast. I haven't got much time. But yeah, just to try and get people profitable. It is possible for the average guy to get profitable. It's been proven. And ultimately what I want to do is actually get a band of traders. We've started the automated turtles. Instead of Richard Dennis with the turtles, we got the automated turtles. So these are the guys that are trading on EAs, on MT4. And this is relatively easy to get involved with. Everybody can get involved in it. We started with one EA actually in January, which is foreseen to have between 5 and 8% profit for the first year. And we're already up, I think, 3.04% in a month and a day now. So looking quite good. And my idea is to add about 10 to 15 EAs together and maybe looking for about 60 to 80% a year, something like that, and then go to the market. Hopefully, go to the market this summer, somewhere Abu Dhabi or the Middle East, possibly the Far East. I come over to your place and pick up some money, pick up the loot, bring it back, and start trading it. So that's it, and bring in some people, because there's people who are doing professions which they're quite, obviously very, very good at what they do, but they like to do other things as well. Want to be interested in some money management. It's a good opportunity. If you manage money, that is where the money is in trading. In fact, it's managing other people's money, because most of these people will have a lot more money than the average trader has got. And this is part of the problem. If you have $15,000-$20,000, you stretch to try and make that into 50, and that's where you blow up. But if you have 15 to 20 million, you're quite happy to trade that at maybe 2, 3, 4% per annum profit, and then take 20-25% of the profit, and the guy's happy, you're happy. That's the way to do it. So that's what I'm trying to educate people about.
Love it. So it looks like we'll have a lot more topics to talk about than what I expected. There's going to be price action. I know you're a price action trader.
Yeah.
We need to talk about EAs as well, because that's really interesting, even for myself. And also this aspect of trading for others. So once again, if you guys have any questions, just comment in the chat. We'll make sure to answer those questions. We have Marcel and Hannah who just joined us. That's great. A lot of people watching. So I want to hear about kind of your trading style these days and what you're trading. I know you're doing a lot of things which I'm really impressed about. You're working in a bank, trading on different time frames. To tell us what that looks like a little bit.
So just to trying to educate everybody about how it actually works from a banking point of view. A lot of people think that there's rows of traders in a line, sort of bums on seats, and millions of screens and the rest of it. All these guys prop trading. A lot of that, especially since 2008, has actually gone. Because of a lot of the scandals. A lot of it's just been automated. I think people like UBS, that their Forex trading is about 90% automated now. So a lot of it, if they ask us to buy 20 million or something like that, we just put it into a machine. The machine does it for us. So it just nips away at the market at a certain price. It will buy a million, buy a million, buy a million. Just carries on doing this. So there's not really so much interaction as there used to be. If you see what we were doing before, where it actually had to be done on a telephone across to New York, it's all done over the wire. It's done by a computer now. So there's less of guys sitting there on seats, screaming down telephones. The image of that is slowly dying, just like the floor traders died as well. That's the first thing. Second thing, there's a lot of disruption, a lot of disruptors in the foreign exchange market. New guys coming in, people like Virtue, high frequency trading people who are becoming, taking a little percentage of the market. So very, very clever guys, jeans and t-shirt guys, not necessarily, like me tying a suit. So I think very young guys, intelligent, clever. They're breaking the models, and a lot of the banks are obviously feeling that. A lot of the big banks are feeling that, so they're having to. They're being disrupted. That's what in the terminology they use, and they're obviously having to react to all that. So that's what's sort of going on down there. And as I said, there's a robo advisor, what they call robot advisors, are taking place in Nutmeg. There's quite a lot of that going up in the Netherlands. In the US, obviously, it seems to always be in advance. I don't know some of the names of them off the top of my head, those guys, but it's a lot of traders sitting with IT people actually now, telling them about the strategies, the IT people actually coding it and then whacking it into a program and testing it and making sure it works according to what they want to do. And so the management, they win because they don't have to pay so many people. They get rid of people, they can get rid of offices. They got to buy a few more computers, obviously, to run this stuff, a few more IT people. But on balance, it's easy for them, and they're trying to get away from all these scandals and the rest of it, which have been going on as well. So from banking side, that's what I do there. From the personal side, I got a little bit disillusioned in 2008. That's why I started my site, because I thought everything that was going on with the housing crisis and people were losing money. And I saw accounts, down by 75%, stuff like that.
Wow.
Yeah, I mean, so if for example, a high net worth individual down 100 million, down 75%, still got 25 million, which to most people is a lot of money. So he would be okay. But I also saw people who had 100,000 who lost 75,000. And if you've only got 25 left out of 100, that's a sort of life-changing situation. So I got a little bit fed up with that and decided to try and level the playing field. So I'm trying to take down a couple of banks, actually, personally, single-handedly. That's sort of tongue-in-cheek, but that's the sort of motto we got on the site. So we're trying to actually take some money back from these guys. Not easy, but you need to be disciplined, but it is possible. So that's how the exact trading started. And I put out these couple of videos twice per day. I've got this price action trading course. I've got some EAs which are coming out, and I've actually just got a new momentum indicator which I spent ages developing, which is a price action indicator. If you understand what that is. So it's based on price levels, which is what I look at. That seems to be very, very good. People are having some success with that already, which is good. Trying to educate people. Of course, a lot of it is about they mustn't overtrade. They have to have the right amount of capital. They mustn't get scared in the market. They mustn't deviate from the plan. All this type of thing. And that's the problem with not necessarily with retail traders, but that's the problem with prop trading. You just get too emotional with what you're doing, and that's why a lot of the big traders have moved everything onto a computer, because they just flick the switch and walk away. If the rules are good and they work, then they flick the switch and walk away.
And what does your trading look like? Because you're trading different time frame, you told me before, and I know we talked just before about news and the fact that there was news coming up in like 25 minutes,
about
and you're not watching news at all. Yeah.
No, so. I mean, I've got a couple of screens to my left here, but I'm not. I mean, it's because this is actually a question I had from some guys this morning. What should I do about FOMC and the rest of it? I mean, if you're trading the 4 hour on the daily and it's a type of swing, just let them get on with it. Don't get sucked into the thing. If you're trading a 1 minute chart, actually, if the FOMC comes out trading a 1 minute chart, my advice would be to drop that to a 15-second chart and trade with the trend and get yourself a good broker, a very, very fast connection, and you can make money on it as long as you've got a good broker and the spread doesn't go out too far. But you need to see the definition in that candle. If you just get one spike in that candle, that's no good. We used to trade actually down to a 2-second chart, believe it or not, and that is absolutely superb when you're trading news. So then you can see the definition. You can actually see you actually see the curve like this, as opposed to just a spike. See a spike, you don't know actually what's doing it. It's just going down, but is it actually bottoming out? Is there anything in there other than that? So for news items, you've got to drop the time frame dramatically down to about 2 to 5 seconds, something like that. But for what I'm trying to do now, trying to help people, is just let them get on with it, really. And most, as a lot of people on my site will tell you, guys in my chat group will tell you, most of these moves, they get reversed sometimes within a couple of hours, sometimes in half a day or 2 days max. So if there's a big move to the downside today, unless it's something really shocking, normally by about Monday or Tuesday, the price will be back up to where we started. So a lot of it is just emotional knee-jerk reaction, and then people realize, well, actually, it wasn't so bad after all, or they revise the figures. They always revise last month figures. That's what other people don't realize. They're revising the figures, the jobs figures, the whole time. So what everybody was upset about last month is now revised, and we're back to where we were. So it's just people, the market makers need to move the market in order to get people to trade, so they can make money on the spread, and then the brokers can make money because people trade. etc., etc. They need momentum in the market, so sometimes it's pushed a little bit further than that it needs to go, I think. So, but that's that aspect of it. And then obviously what I specialize in, originally what my real specialization was is this London reversal, which we don't always get these days because the market has changed quite a bit. But for the guys, a lot of those guys are working, so I help them with swing or intraday trading. Intraday trading is the thing we're really looking at. Just short bursts of momentum.
Cool. Are you using the same strategies intraday and on a swing basis, or is it different things?
Yeah, I mean, one of the major things is obviously risk control. It's the first thing. So the risk control, you must have an idea about where you're going to come out. Doesn't matter whether you're in whether you're in swing or whether you're in intraday. You must have an idea about where you're going to come out. That's the first thing. So capital preservation is absolutely of prime importance. Otherwise, you can't come back tomorrow. If you lose 80% of your capital, it's catastrophic. So I'm teaching them, hopefully teaching them that's the first thing. We've got to watch out for capital, which means manage the leverage. Most professional traders are down to about something like leverage of 5, absolute tops 10. A lot of people are about between 2 and 5. So that if you get something like Swiss National Bank move, you can still come back to the game tomorrow. So I'm trying to teach them that, but a lot of the momentum moves we're doing at the moment are almost the same intraday or swing, same type of thing. Obviously, you just have to hold a little bit longer. And that's the problem for people to hold. If you look at this euro run up since December, you could almost have bought, I think it's around about 27th of December and still be holding now. There's not really been any pullback. But how many people did actually buy in December and are still holding? Not many. I think that's the answer to that. So I'm trying to help people with that. It's very difficult to get people to do that, especially if they're slightly undercapitalized, because they're trying to put more money on the table than they probably should do, which is why in turn, I'm trying to get them to trade very small, then take their trading slips to the money managers and say, okay, this is what we can do. And then you get seeded some money that way, which is also another method of becoming profitable. It's a nice idea.
So here's what you're going to do, guys. So comment in the chat if you're using some sort of price action for your strategy right now. If you have no strategy, just comment in the chat as well. And if you're watching the replay, comment in the comment section below if you're using price action or not. And we're going to try to help you guys create a strategy with price action, because that's what I see as the biggest problem. People don't know how to create a strategy. Price action is like this big, huge thing that you don't really know how to put together. And we'll try to have Paul to help you guys try to put everything together. So comment in the chat and we'll get to that right away. So Paul, you were telling me you have trades that are really long time frame and really short time frame. Yeah. So what does that look like?
Well, yeah, as I was saying before, I've still actually got some trades short of the Draghi move, which was I think in 2015 now. Off the top, so for British pound and US dollar, euro US dollar, still got some short trades off the top there, which I actually probably now have to do something with, because both of those currencies are reversed quite strongly off the bottom. But what I'm trying to do is catch some very, very big swings and not very highly leveraged on those positions, so I don't actually have to look at them. I mostly don't even think about those things. It's just a little bit of training for myself, actually, in order to teach myself to keep reiterating the fact you have to hold trades. The intermediate trades that I've got are a little bit more highly leveraged, a little bit more important for me, where I'm making the wedge of money. Those ones I have to watch quite carefully. But what I'm looking to do is just catch the momentum swing. So if the price is moving, the train is moving, just going to get onto the train. You have to a little bit of timing aspect about getting onto the train, and then let it take you out as far as it wants to take you out into the country, and just take you for a ride. And that's actually what's happening at the moment on British pound and US dollar. It's been very, very good. Yeah. And the last, prior to that, 2016, 17, there's a little bit of sideways activity on the bottom there for quite some time. But since Trump came in, and since Goldman Sachs said that the euro was going to go down to parity, it went the other way. Of course, that must have been the hat tip, in fact, and it's up 25% since then, which is a phenomenal move. In fact, in about a year and a half, something like that, a year and just over a year. I think it was November 2016 he came in. He was inaugurated. Inauguration was January 2017. Well, so very, very good move. But what it looks like is just trying to get on this trend and ride it until it just peters out. So I'm looking at momentum in the trend. And one thing, if I can give one tip about price action trading, and this is something that people get wrong the whole time, is that when you want to go and buy a TV, for example, you want to buy yourself a new TV, you're looking around in the newspapers and on the internet to find the cheapest price. In financial markets, they work in the completely in a different way. You need to think about buying high and selling even higher, as opposed to trying to buy it low. Now, you can buy low, but the market has to have turned at the point when you buy low. So a lot of people like to buy pullbacks, which is fine, but that pullback has to have actually pulled back. You can't just put a trade on, you can't put a position, a buy order on a Fibonacci 66% retracement or something, go out and play golf and hope that things are going to actually reverse. And this is actually what surprises me. I see this everywhere on Twitter, on everything. They put this stuff up, but if they just waited to see what actually happened when it hit that level, they would increase their win rate by probably about, I don't know, 30, 40% or something, because it's much easier to see if the market has actually turned, and then you say, okay, now I'm going to go with it. Let the big guys turn it for you. Don't stand and don't try to be a big guy. I mean, that's also another message. Don't try and turn a market yourself, because you won't be able to do it. It's like the Titanic, the film where the guy tries to turn it. He takes a long time to come around. Financial markets take a long time to come around. So you got to buy actually when the market is going up. So that means buying highs, or buying when the market has turned after the pullback. That's the first thing. Then also, don't be surprised about how far a market is going to run. If I never make any predictions, but what I will say is, if this euro gets above 125 now, you can see it on the chart, it's almost certainly to run and run and run. How far it will run, I don't know. But this is a big level. If it gets above there, there's clear blue water up there. It's going to go right back. It could go to 130, could even go way beyond that. But you mustn't actually set that figure in your head. You must just sit on the train and let it go. When the train stops, you get off. Simple as that. So if you set targets, it's going to go here, it's going to go there. It's not going to work, because nobody can predict. I mean, I think you probably agree with me. Ultimately, nobody can predict. Goldman Sachs can't do it. Barclays can't. Nobody can do it. If you look at their analysts, they pay them $250,000 $250,000 sterling a year or something like this. You look at what they actually do. Most of it is just put it straight in the bin. And they haven't got one guy doing this. They got whole banks of these guys. They got whole departments of these guys coming out with this stuff. And it's the same for stocks, same for commodities. Stuff happens, and you can't predict it. And it's always the instrument that you don't think is going to go up actually does go up. Nobody was predicting the euro was going to go up. They all thought it was going to go down. Went the other way. So you know what I mean. A market is driven by people, and we can't see. Unfortunately, we can't see into the market's collective heads of these guys. So I would say two things. If you want to buy on a pullback, make sure it's turned. So you don't necessarily have to use sort of price levels that I use. You could use Fibonacci's. You can use anything you want, but whatever it is, stick to it. Use that, but make sure the market has actually turned for you going. Don't just put a buy order on a 25% fib retracement or something and just go out to lunch or something. Because when you come back, it may well have gone straight through. But if it hits that and starts to bounce, it looks like it's going to go up to the actual. The market is curving a little bit like this. It's probably a sign there's other people in there as well that you could go with. I personally like to buy the breakouts to go higher. Because again, that's what I was talking. Buy high and sell even higher. Because when they're really feeding, when the fish are really feeding, everybody wants in. That's the bit when you got to be in. On the pullback, it's sort of they're all a bit wounded, and it could be a little bit half-hearted. But when it's breaking the highs, so I'm saying if this 125 breaks, I mean, I'm already in from quite low down on the British pound. But if the euro breaks the 125, it could bring in a lot more people. Plus, there'll be shorts up the top there that will have to reverse and come out of their positions, long-term people, which means that could fuel it even more. So think about buying high and even selling even higher, but only sell when the price starts to hesitate. And hesitate means it's just going sideways. It starts to go sideways. If it's not going up, and it's going sideways, then you better just step out, at least put 1 foot out of the train, take off 25%, 50%, something like that. And this is actually what a lot of very, very big traders do.
That's a great strategy, and that's how I started to kind of become to go from a losing trader to get kind of a more profitable traders. I took some position off, like half of it, like at some point, and I was able to like cut a lot of losses that way. So that's really helpful.
Yeah. No, I actually had one of the guys on I used to work with years ago. He gave me some very simple tips like this, which actually sound simplistic, but it's actually quite good for your psyche as well. Because if you sell out 75% and then it carries on going to the upside, you've got a problem in your head and oh, why did I sell 75? I've only got 25 left. But if you do 50-50, you're never wrong. So if it crashes, you've still got 50% profit. And that's part of the game as well. You need to have that in your head, that it's that you're quite balanced in the head, that you're happy with the decisions you make. It's very important to have that. Otherwise, you could consistently second guessing yourself and turning around inside.
All right. So we've got a lot of people using price action in the chat, and welcome Scott. Welcome. We have a lot of people. That's awesome.
Yeah.
So I want to know, Paul, when you look at a chart, what's the first thing you look at?
Okay. When I'm looking at chart, what I'm looking at is the is it going up or is it going down? How do I tell if it's going up or going down? If it's going up, it's breaking, depending on the time. Well, on all time frames will be the same rule, irrespective of the time frame. Some time frames are a little bit easier to see. Is it breaking the highs? Is price breaking recent highs? Is it going higher, or has it broken some highs and then come back down again? There's a couple of patterns that I like very much. This type of, very difficult to describe it without a chart, but when you get price coming up to a high, you get this pressure from underneath, and there is actually this on the British pound. In fact, today could break today. This is what I call a coaling mechanism. You have a type of higher lows underneath, pushing underneath, coming up towards a resistance area. For example, the price is going to the upside, and you've got the highs just keep getting higher and higher. The lows, sorry, keep getting higher and higher and up, pushing underneath. And at a certain moment, it just pops it just pops through the level. And that's something which I'm looking for all the time. That's for sure. And then depending on what sort of thing I'm really looking for, I quite like big candles. I got some EAs which I actually call big candle EAs. So when you get this huge push of momentum, again, I'm buying the high depending on the size of that candle, and then I'm looking to get the follow through so that candle will bring other people in. So I'm looking for those types of trades. For daily type of thing, in London Open, I'm looking for a reversal of what I call bank levels. So it's when they push the price off the 8 o'clock open to about 40-50 pips. It doesn't happen as regularly as it used to. And then looking for a reversal off that. So I'm looking for that. And then also for the longer term, again, I'm looking for this momentum to the upside. So just blocks of 3 candles, for example, 3 blue candles, 3 green candles going to the upside. Very, very powerful. Means, on a weekly time frame, means there's a lot of big traders who are buying that stuff, because to push this around, you do need quite a lot of money. To push some of these markets around, they're talking about big money, and if they push it in that order, it means that somebody somewhere wants to get the price away from where they've entered, and it's a momentum which is going to suck in other people. So looking for moves which are going to suck in other people as well, because if I'm in, that's fine being in, but I then need someone else to move the price higher so I can get out. So I'm trying to get in as on the breakouts, buying the highs, looking for the momentum follow through as well. So that's mostly what I'm looking for. I do have some mean reversion stuff as well, but mostly momentum and breakout trading.
Mm-hmm. And I think what most of you set up are going to have in common is like some sort of support or resistance zones that you identify. Right.
Yeah. Okay. Yeah. So, I mean, at the bank, again, this is, I don't know whether it's well known or not well known, but a lot of the people that come on the site, they haven't really heard about it before. A lot of prop traders, the old-fashioned prop traders, they used conglomeration of weekly, monthly, and daily levels, so highs and lows. And when you get these highs and lows coming together, creates a resistance or support area. They're very, very powerful, and they come in and out of those levels. A lot of quite big bank traders do that. They work very, very well. Nothing works 100% of the time, because if you get a big move, if Trump stands up now or something, or someone says there's a button pushed and South Korea are going to do whatever, the price is just going to go through any bank level. It's going to do what it wants, a bit like a Brexit move. So there is no prediction on that. But these bank levels work very, very well, and I show them on the videos as well on a daily basis. And you can trade off them. You can trade off them if you, so long as you ensure that at the level you've got the guys coming in to do that buying to turn it around. So if the price is coming down towards the level, you don't just put a buy trade in there. You wait for the other guys to turn it, and you know that they're turning it at that level. It gives you a lot of confidence to go into the trade, and then it gives you a bit of surety that price is going to go in your direction. So I'm quite good at. Oh, we've got a down move, I think, just started. So this must be the figure. Yeah, it's selling off a little bit. I'm quite good at getting the right direction. It's the management of the trade after that, which is for most people quite difficult because they don't know how to hold, how long to hold, when to get off. But yeah, that's the type of thing that I'm looking for. So those bank levels are very powerful. But what I would say, because a lot of people don't understand the bank levels, or they're married to fibs or whatever, and actually it doesn't really matter, because there are also a lot of people, hedge fund people, who use fibs. I've never been able to get on with fibs. It just never really appealed to me. It's like, like in a blonde woman or a brunette or whatever, it doesn't mean it's wrong. But what you've got to do is just make sure that that price is turning at the point, if it's coming down to the fib or whatever the level is, round numbers I use quite a lot as well. 125, for example, big round number, big number, 125. I mean, halfway in between 120, 130. That's what I'm saying. If it goes above that, get above that, I think you're going to go to 130 again. No prediction, because I don't do that. But I think you'll find that they will take it up. Everyone is waiting for that number to be broken. So those types of things are great, but you must see that the other guys, the big guys, have taken it first. And then you just go, it's like one of those feeder fish on the back of a shark. You know what I mean? You probably, it's a sort of, I don't know what the word is, but you're just feeding off the back of the other guy. You're watching what they're doing, actually. So you've got to change your psyche a little bit and say, well, okay, it's not that you don't know what you're doing. You're being intelligent enough to say, okay, I can't really predict this market, but I see these guys, the big guys, have turned it. I'm going to join in the fun. And that's basically the way I do it, because there's too many big guys out there. The market is too big in order to try and influence it or anything. So that's what I'm doing.
And would you be trading, let's say, a level that's only appearing on the daily chart and not the other time frame, or does that have to be kind of an alignment to?
Well, no. So, for example, on I mean, the specialization was 1 minute chart. So I'm using conglomeration levels on a 1 minute chart for the London reversal, but that's been in between about 40 to 60 pips. They tend to move it about 40 to 60 pips off the open and then reverse it. Not on every day, but if it's reversing off there, then I will take that. But no, if we go up to the daily or the daily or the 4 hour, I just use a conglomeration of maybe about 20, 25 monthlies across the charts, and you're just looking for about 3 or 4 which come together. So, okay, this is just selling off a little bit on the euro there, so doesn't appear to be much of a move, but yeah. So I use those levels, but what I would stress is that I think it's because people like their own thing, which is fair enough. But I think what the mistake that they make is they don't wait for the market to move. I've seen that everywhere. Everyone wants to predict, and actually, the day you say, you hold up your hands and you say, "Well, I really don't know what's going to happen. I'm just going to follow the market, follow the momentum." It's the day you actually start making money.
Yeah,
that's no, it's and actually maybe what has to happen is as a trader you have to come through some sort of education. I think some type of internal education where you ultimately say, well, okay, I give up. I really can't predict it. It hasn't worked, because there's some of the smartest guys in the world in this game, especially in stocks. Less so in Forex, but in stocks. And if they can't do it, then it means that it's just too big to handle. It's like trying to wrestle a crocodile wearing gloves coated in olive oil or something. You just can't do it. So just let the associated market fight it out, and then go with the winner. Mm-hmm. That's what I do. So
totally. And when it comes to understanding and looking at whether price reverses at a certain level, I know like everyone's gonna have its different setup. Yeah. Like I have my own setup that I look for, and that's where people are different. Yeah. But do you have some things that you look for? You would recommend people to look for?
Yeah, I do. So, okay, there's a couple of things. When the price approaches a level and it's very, very fast, and it comes up to that level, uh, very, very fast. It's type of, if we talk about a resistance point, so the price is going to the upside, and it's almost a vertical line, comes up very, very fast, maybe runs 60, 80 pips up to the line. It's very unlikely that it's going to have the speed to actually go through that level at that point. So what typically happens is that the price there's an equivalent size candle to the downside, and that for me is the signal to go short. So when you get big candles coming up into the resistance point, you get then a really good push away from that. That is an indication that someone somewhere has really said, okay, we don't want this to go any further, and that the higher you get in the quicker you get into that candle, the higher you are in to that resistance level, the better from a statistical point of view. You got more chance that the price is going to move away a little bit further, and the worst that can happen is it just turns around and stops you out above the level. So I'm looking for that. If the price approaches the level very, very slowly and very, very carefully, it's more likely to actually break out at the top. If you look on a chart, you will see that. So the aggressive moves, they're more likely to reverse than the sort of very slow moves, which just come up very, very slowly, and they're a little bit more constrained, if you like. I just realised we got some sort of thunderstorm here. All the lights have.
Oh, that's what I was wondering.
It's all gone dark. It's
dark.
It rains the whole time here. It's the middle of the afternoon. Dear, terrible.
Okay, I was wondering. Okay, yeah. So if you're gonna, let's say, buy at this support and like after a big push at a support, that means your stop loss is gonna have to be bigger, no?
Say again. So if I buy on, if the price comes down to support,
after a big push on a support, you would have to put your stop loss. The stop loss is going to be bigger.
Well, no, what I'm doing is saying, imagine the price is coming down. So it's coming down, and you've got a resist. You've got a support there. It could be fib, could be one of my bank levels. It could be anything like this. What I'm looking for is to see how does the price approach that level, and typically where it starts, where it's going to be a level where there will be a reversal, is it pushes very, very hard into that level in a big final push, a type of exhaustive move into that level. Those are the ones that are most likely to reverse. They're the ones that are most likely to reverse. And the ones which come very gingerly towards it, very, very softly, very controlled manner. There's nothing out of control. Most of those ones, they certainly won't reverse in the same the manner, and majority of them actually will just break that support area and go through at a certain point. It won't necessarily happen directly, but they will build up to that and then go through.
Mm-hmm. So we have an interesting question here from Ravindu. He says, "How do big player reverse the trend? How can you think like a big player?"
Okay, so what I would say is about how to think about a big player. I would just how do I think about? Just think of Switzerland, a big bank, and the guys with a lot of money down there. They need to put their positions in for the long term. They're not like us where we need to make 10, 15, 20, 60 pips, something like that. So they need to think about daily time frame, a weekly time frame as well. That's even monthly time frame. So that's big players. If you see a really good up week where the whole week is green, and you get a couple of those, as I said, maybe 2 or 3 weeks like that. I think on the British pound, we've had 6 weeks on the trot green. If you look at the chart, I think it's 6 weeks. That is big players pushing the market around. And I do some sort of Brexit commentary because I'm obviously from the UK originally. I have no real opinion on the Brexit, but I think the market now certainly believes that it's not going to cause a problem. And that's big players putting their money where their mouth is. So to think like those big players, I would watch what they're doing. So I would say, what are they doing? If those guys are long, I want to be long too. I don't really want to fight those people. So I want to be long. So to think like them, I would say, watch what they're doing and then go with them. I don't think there's anything wrong with that. This is a marketplace after all. This is a type of video game. Think about it like a video game. You got to win the game. You want to be with the good guys, the guys that know what they're doing, and I would go with them certainly. So hopefully that answers the question.
Yeah, and I'm just wondering for someone like myself, because I personally trade more reversals than pullbacks and breakouts.
Yeah.
does the same thing apply, or is? Because I guess it's a bit different. You want to enter, like you don't want to wait for a big candle to enter necessarily, on the weekly chart,
So
for example.
yeah, but on the reversals, there's several ways. What I do for reversals is what I'm looking for is a breakout above. Say for example, this 125 we got on the euro, okay, because everyone's looking at that.
Mhm.
If there's imagine that it goes above 125, makes it to about 125.50, and what I'm doing is at that point I'm looking. There is no rush. That's the other thing. There is no rush to get into the game because there's plenty of pips in the game. What I would then do is just wait. Let's just see what happens. If it stays up there for a couple of days or maybe a day and a half, a full day's trading plus a London Open, it's up there above 125. Then you can start to think, okay, the position has confirmed above the breakout. That's fine. But if imagine it stays up there for half a day, it spikes up to 125.50, spikes back down into the range beneath the 125 down to about 124.5, and it stays down there for the rest of the session. That is the signal to go short because it's properly rejected off the break of that resistance. And you've given it some time to confirm. It's not confirmed, and then you can go short off that. So that's how I'm looking at reversals. But has the price confirmed? If it confirms above, it stayed above, everyone's happy to be up there, then that's fine. It means it's going to go to the upside. If they push it up and they bring it back down, sometimes it's in a matter of an hour or 2 hours, then that is the point for the reversal. So to do the flip side of your question, Etienne, if I'm looking at the breakout from the other side, in my example, I would not just want to put my buy order, say 5 pips above the high there, and just buy willy-nilly, because nothing is confirmed at that point. And this is, again, the mistake that people make. I don't know if people can get what I'm saying. It needs to be up there for some time so that the big guys have confirmed that it's okay to be above 125. That's what I'm saying. And if it comes back down within half a day, something like that, back down to 124.60, 80, they don't want it up there. Therefore, which way do they want it? They want it down. Then you go short off that. So I don't know if that hopefully maybe answers the question a bit.
Yeah, yeah, and I think it's a big point that I never really took time to explain what we talk about, and I
Yeah,
don't necessarily take time to look at it necessarily, but I've seen my best trades are definitely happening like faster than the
yeah,
one that when price get at the zone they happen like quick, and
yeah,
that's how it is for sure.
yeah,
So
yeah,
love it you confirm and that you explain as well. That's really
yeah,
nice.
yeah.
A lot of question here. Let's see. There was one about the MA or the time frame. So which time frame is best to predict a major trend?
Okay, again, I think I will come back to the question of the big traders. Okay, so if we assume, it's very dangerous to assume anything in financial markets. That's the first thing. But if we assume that the guys with the big money, they make even more money, which I think it's not 100% guaranteed, because we have had occasions where big hedge funds and things and LTCM and the rest of it are all Nobel prize winners and everything. They blew up nearly brought the entire banking system down. But if we assume in general the big money is well managed, they're looking at their risks and the rest of it, then we got to be following those guys. And those guys, they're not in the 1 minute or the 5 minute. They are in the daily and the weekly and the monthly, because they're actually very, very busy doing other things, like going to Davos or wherever it is they go to these things. Is If you're at that level, I'm actually just I actually work for a asset management over here, but at that level, when I'm talking about people who've got a lot of money, they have a circuit of stuff which they do. They go around the entire year. I think they call it the season. It starts, I think, around about now somewhere, where they go skiing, do this Davos thing. They go skiing. They do horse racing in wherever it is on the frozen lake in Geneva, or I mean, it's a totally different thing. But those guys are not looking at the 5 minute. They're parking their money with money managers, and those money managers are putting it into something like the weekly, and they will have taken a position on the euro for maybe the next 3 to 6 months with the trend. Almost certainly with the trend. They will diversify across a lot of different currencies, a lot of different commodities. The big CTA guys, as the guys on my site, well, I've said this many times, a lot of the big CTA guys have got their big money across up to about 175 futures contracts. They diversify across a load of instrument types. So I don't know if that answers the question, but those guys are in the longer terms, the daily. You can see the daily now, Euro US dollar daily, British pound daily is still pretty good. It's all very, very smooth. What you got to look for is that smooth trend, that 45-degree angle. Doesn't always happen. Australian dollar, US dollar has been very, very good. We had a lovely trade off the top, short. It's now gone right back up again. You just use something very, very simple to just measure that trend. Even I hate to say it, because I don't really use indicators at all. But if you just put a very simple 20 moving day average up against a price, you will see whether that thing is actually moving to the upside and trending or not. And if you do it on the daily, it's always going to be smoother. The weekly will be even more smooth, and the monthly will be even more smooth. And in fact, the other thing is to say is there's very few people, apart from these big guys, who are looking at weekly and monthly. And so by implication, if they're not looking there, it's probably where the money is, because all us guys are down at the 5 minute and the 15 minute, and the brokers are taking all the commissions and so on and so forth. And most people are losing money. So you've got to think out of the box, but I would say go for this longer term trades, this daily, weekly. Try and catch some of those big swings, in fact.
Big takeaway right there. I love it.
Yeah.
Question from Harry here. Are correlation important for you for range trading, or I guess for any trading? Do you look at correlation between pairs?
It's funny you should say that. I do look. I tell you what I do look at is, for example, if you look at the British pound US dollar, obviously very, very heavily traded, actually a bit of a graveyard for most retail traders. What you can see, if you look at that as against the British pound Australian dollar, you will often find that the British pound is several minutes in advance. When I say minutes, I mean maybe 90 seconds, something like that, in advance, which is massive. Not always. You've got to have, so that's sort of correlation in between similar pairs. Obviously, there's correlation. You've got triangular arbitrage and the rest of it. That's very, very difficult. Even the banks can't do that now with banks of computers. They can't really do it. And the fact is that once one gets out of step, it will be arbitraged back into line very, very quickly. So, and they're offsetting the whole time. So if Barclays happen to end up, I mean, this NFP looks like it's pretty weak, but imagine that it was very, very heavily short. You could heavily to the downside. You got to understand that the banks actually they're making markets, which is as difficult or if not harder than what we're trying to do, because we're allowed to go in long or short or not at all. They've got to make a market 24 hours a day on both sides. They're just taking the spread, and their book regularly gets stretched one way or another. So if there was a big, maybe the market came up sold off 200 pips here now, they would probably start netting those trades out against one of the other currencies. So there's a lot of that goes on, and they will be looking at the correlation between. But because of the computers and the way everything is now, it's all arbitraged back in very, very quickly. So I like the correlation where one is leading and the other is following. I certainly like that. And it does occur more often than people think. And you go with the stronger pair, which is the British pound US dollar, obviously, because that's the most widely traded. And then the other one tends to follow suit a little bit afterwards. So maybe hopefully that answers the question. Hopefully, anyway.
Love it. Marcel is asking, how do you prepare for the upcoming stock market crash?
Well, that's a good one. Well, Marcel, again, this is the whole point about, I don't know if there is going to be another crash. I know that sounds like it's a crazy comment, but it's all over Twitter. It's all over everywhere that something's going to happen. But they quote this crash is going to happen. I just sit on a train and I'm going in one direction. And if you look at stocks, I'm not a stock person, but obviously I know I have people around me that do stocks in my daily business. The US stock market, someone could correct me if I'm wrong, I think was up 40% since Trump came in. They've been calling the crash the whole time, but if you just sat on the train and just went up with the train, which is what the big guys have done, then you'd be quids in. So that crash, if and when it comes, I mean, you know, I use ATRs for stops. So Etienne, you know, average true range stop. I have what I call an Armageddon stop. So I actually trade a lot of positions with effectively no stop, what you would think is no stop, but my stop is way out somewhere where I can't get heard, which is what I call an Armageddon stop. So if we have an SNB, something like that, a really big move. So I've got sort of loads of positions open at the moment. So for example, I've got short position on the euro at the moment, but I got stops which are about 200 points above that, 200 pips above. But that's just there for a catastrophe in case someone pushes a button somewhere, or you know, or Trump gets up, says something, or I don't know, Brexit is cancelled, or everything that can happen. Because this is financial market, you know what can happen. It happens all the time. But so I just want to be sure that I'll be protected in that case. And that's about, you know, 5 ATRs is about, you know, it's about really, yeah, at that level I can handle it. So I don't really, you know, the crash, you know, markets, I think it came off, didn't the Dow Jones came off the other night about a couple hundred points or something. It's bound to reduce a little bit, 4%, 5%, but that's all normal. But I wouldn't call anything. I wouldn't go around calling any crashes. What I would do is try and find a trend, get on the trend, and then just ride it. But keep your stop. You can do it one of two ways. Be prepared to take lots of small hits and small gains. I like to let that thing ride, and I put my stop well out of the way because I don't want any spikes coming down and up and the rest of it, which to catch me. So, and I'm prepared to keep my position sizing very, very small so that I can take those stops and ride to the upside if the trend is to the upside. So that's what I do. And I really wouldn't focus on the crashes and things, actually, to be honest.
Cool.
I don't know if hopefully that answers the question. Well,
yeah. Another
probably
question
going to
from
crash
Marcel.
tomorrow. Yeah.
Yeah. So another question from Marcel. He's using right now the RSI on a higher time frame to confirm the trade and increase the probability of the trade being right. Do you have any advice on any filter that could be used to increase the probability of trades?
Good question. That is the $64 million question, because actually anybody can put up a moving average crossover system or similar, because they almost give you the same signals. If you use price levels, they will get you into the trade earlier. They will get you depending on the time frame you're in, a 15-minute time frame, probably get you in about 6 or 8 pips earlier and get you out sooner. That's what I do. So I don't use averages. I use actually price levels. But the question was, can we filter? That is an excellent question. There are a couple of things, and I'll tell you, there are a couple of things. I'm just trying to think, because you mentioned RSI. Again, what we were speaking about before was buying highs or waiting for pullbacks and then buying the turn. Not directly linked, but hopefully it will answer the question a little bit. If you know, what's his name, Connors, he's got this big thing about RSI2, very, very fast RSI, which again is proven in the market. There's a lot of automated trading people who use RSI2 for reversal trading. Now, if you were to use that to get into the trade off the reversal, that already filters, I'll come to my point in a minute, that already filters a lot of trades because you are buying already on the pullback. I don't know if you see the analogy. What I'm trying to say is because you're not buying highs, it's pulled back already, and the RSI2 is turning, and that actually proves that the market is turning. So the number of whips or trades, or the false trades at that point, is very limited because you're already on the pullback and you've already done what I was talking about earlier, that the RSI2 has helped to prove to you that the guys are buying and that you're in. So all that can go wrong at that point is that actually it comes up to about the 50 level and then crashes back down again. But you would have time to get out. So there's very few false trades on those types of entries. Now, on the entries that I do, for example, the breakouts, I'm buying the breakouts, we do get false entries because there are quite often candles which is popped to the upside and there is no follow through. So that is a false breakout. Now, what I tend to do is to use chandelier exit in a very different way. And just to explain how I do it, if you think about a chandelier exit, which is the, you know what a chandelier exit is, Etienne? Have you heard of the chandelier exit?
Exactly.
Yeah, it's an ATR based exit designed by a guy called Chuck LeBeau. So it's chandelier exit. And the reason why they call it chandelier is because it sort of hangs beneath the lows of the price as it goes up. And as the ATR expands, so the exit will expand as well. It gives you more space. So it's giving you more space as you go up. As the price gets tighter, the exit gets tighter. And it is actually a very, very good method of exit. A lot of big traders use it. Big fund managers and stuff use the chandelier exit, or something very, very similar, which they may give another name, which then they give it some fancy name, which is actually the same thing, because they don't want to show someone that they're using, something which has been designed by somebody else. They want to do their own work. But if you use that exit, and so you've got to imagine when you're buying, the exit is underneath, the price is going to the upside, it's trending to the upside, and then you eventually get stopped out. Now, if you get a false signal, if you make sure that the chandelier is always underneath your price, then that will get rid of a lot of false signals. So I just try and repeat that again, because maybe it's not clear. Typically, when you're buying, okay, price is trending to the upside, the chandelier is underneath, and eventually it will get hit because you just get taken out of the market in normal fashion. Now, to filter out some false trades on those breakouts, if the chandelier is above, because you have a range which is based on highest low, the lows and the highs of the last normally 7 days, and it will draw a line above your price. Then if that chandelier is above price, when you get a signal, when you get a breakout, they're normally false breakouts, and you can get rid of them. That is a very, very good method of getting. So it's actually using the chandelier for something which is not supposed to be used for, but it gets rid of stuff. And then the second thing is what I said at the beginning, is buying on those pullbacks when the pullbacks already happened. So the false signals already happened, except you are with the big guys. They've turned it. The RSI 2 turns up, and then in you can go for an upside trade. That also works quite well, actually. So hopefully that's answered the question. It's a bit convoluted.
Yeah. I think it's gonna be a good answer for sure.
Yeah, thanks.
And we have a couple more questions, but I wanted to talk a little bit about your course, because I know you have a whole course people can go through, and I've seen many people buy it from me, and like they went through your course and they liked it, so I got some good feedback on it. So let's tell people what you have, and we have a special partnership as well with the academy that I have.
Okay. So the course is actually video training, because I find that videos are the easiest way of getting the message across. It's all charts. And I've got, I think, something like 28 modules in total. It's over 20 hours of training. And there's quite a lot of important stuff before we even get onto price action about the brokers. Now, I don't know if, Etienne, you've had this. I get approached by brokers the whole time who want to do deals.
Yeah. Every single day. Crazy
yeah. Stuff. I mean, me probably not as much as you, but I do get approached, and I'm very, very careful about even recommending brokers. I get people asking me, I won't say every day, but twice, 3 times a week, what's the best broker? There is no such thing as a best broker. That's the first thing. They all change. You've got management changes within companies and things. So what's a good broker this year might not necessarily be a good broker next year. That's the first thing. I've got quite a lot of background because of the bank of working with IT guys, and I've been to the IFX conferences and things, where they do in Asia and also in Cyprus, where all the brokers are, and I've had a look at their software. I understand MT4, how it works, and I just want to, in some of these early modules, and I give you some little tip now, in some of these early modules, I talk about actually some of the tools that the brokers have available to trip people up. And this is also why I like to go longer term time frame, because if you're buying a trade which is going to last 6 weeks, it doesn't matter what they do with your price, your slippage, the entry that they give you, they can't get you, because you're in for maybe 300-400 pips, and they may be taking a couple of pips slippage off you. But if you're only going to go for a 10 pip profit or an 8 pip profit, they take 2 to 3 pips off you. That's a big amount of your your profit. So I talk a lot about brokers, the type of tricks they can be up to, and trying to help people to understand, go for a little bit longer term time frame. That's the first thing I do. And I got quite a lot of good feedback from people on those videos saying that it's the first sort of honest appraisal of how it works. But the brokers have about like 30 different things within the software which they can switch on and off depending on what they want to do, when they want to do it, increase the spread, increase the slippage, etc., etc. There's a whole range of things that they can do. And I'll just give you one now, just to hopefully prove to people that I know what I'm talking about. When you buy and it goes to your broker, you've obviously got the A book and the B book, which I think probably most people know what it is. If it's the B book, the trades stay with the broker. That's when they're purely trading against you. If it's the A book, it goes through to the tier one, to the prime bank, could go through to Barclays or HSBC or whatever. And then what they typically do is they wait. This all happens in a millisecond. So if you're buying it, 125 even or something, they push the price through to Barclays. They will give the price that is requested. The confirmation, the broker then receives that confirmation and just adds on a couple of cents onto the trade price, so he gets a guaranteed profit even at the execution. So because there's a third party involved, it's like me saying to you, Etienne, I want to buy this, buy a sandwich. How much is it going to cost? And I say, €4 or something. And you confirm back to me €4, and then I confirm back to my client. I say, yes, it's €4.10. So I've made 10 cents profit, whatever happens. And this is what happens all day long, every day on all the trades. That's on the A book. On the B book, they pile it up for themselves. That's a different question. That's just the broker trading against you directly. But there's all this going on. There's slippage. There's all sorts of stuff. And on the short-term trading, it eats into your profits and can cause you a lot of damage. So I talk about that. I talk about what is price action trading, the different styles of price action trading, so the breakout, reversals, continuation trades, how to trade each of those particular price action techniques. And there's what I call my Forex uncensored method, which is the London breakout, which is the London reversal method, rather, and then a Tokyo method as well for Asian traders as well, overnight. So it's the Tokyo break in as opposed to the London breakout, which is what most people do. So there's an awful lot in there. I've got some very good testimonials and things from people. So it's genuinely a good course. It took me a long time to create it, but it's genuinely a good course for people, I think, if they're interested in price action.
Totally. And the way it works, guys, is there's a link below the video. And if you buy Paul's course through that link, you're going to get a 3-month complete membership to the Desire Trade Academy with all the program, all the course, all the strategies, everything I'm putting there. And you get access to both. It's kind of a win-win, and you guys get more in the end. So that's awesome. Yeah. So link below, and there's all the details and stuff on how to get your Academy membership and stuff after that.
Yeah.
And as I said, go ahead.
Yeah, no, I was going to say, just from point of view of that, I mean, we're not doing, pure promotion, but just to say, as I said at the beginning, Etienne is a very, very serious guy in terms of he's had some good people on his podcast. I've watched his podcasts. I haven't seen any of the video casts, to be fair. Podcasts got some serious guys on there. He knows what he's doing, and you actually turned yourself round. In my conversation with you turned yourself around from a losing trader into a winning trader as well, and he's now got the lifestyle which is basically roaming around the world from what I can see, as opposed to me sitting behind screens all day long. So I'm a little bit jealous, but it is possible. It is possible. You do have to have discipline, and price action. The final thing I want to say about price action is that all indicators are derived from price. So as opposed to having the derivation of price, which is mostly late, not always, it's mostly late, why not try just with the price, because you're in before everybody else, and that's part of the game. If you can get in 4 or 5 pips before everybody else, that can be over the course of a year the difference between being profitable and not being profitable, actually. So that's really it. So anyway, thanks. Sorry to interrupt you for that.
Yeah, sorry. I really appreciate it. Awesome. Yeah. A couple of holidays today. Awesome. So do you recommend holding trades over the weekend? Question from Master.
I mean, depends on the time frame, but I hold stuff over the weekend all the time. If you're going for the daily or the weekly, and you go an ATR stop, which is quite a way away, it has to be a very, very big upset to cause you a problem. I know that traditionally a lot of big people close on a Friday. Monday they're opening and the rest of it. I think there's a lot less of that going on than previously, actually, even though we're obviously living in a pretty unstable world. There is a lot less of that going on because it's automated, and the cost of getting into trades, out of trades. As long as you're not over leveraged, and I sort of get worried because sometimes if people ask that question, I think, and I'm thinking in the back of my head, I think they must be quite over leveraged. They're worried about the weekend. I under trade. If you look at the Market Wizards, there's one of the Market Wizards books, one of those guys in there. One of the most famous quotes he says in there is under trade, under trade, under trade, which means just if you think you're going to put on, a position of one lot, don't leverage your account up to do the one lot. Just go for a fifth of that and sleep at night, so that you can actually live to fight another day if something happens. That's what I would say. So the weekend shouldn't be a problem if you are not too heavily leveraged. That's what I would say.
Yeah, love it, love it. Question from Joe, and that's a two-part question. So, how many trades do you take to find out if you have a positive expectancy, and then
Yeah.
how much risk do you take per trade?
Okay, that's good questions. Okay, so what I'm doing, actually, I'm permanently testing a lot of things. I have a developer who writes EAs, and I'm permanently testing things. And I like to go back 15 years worth of trades. Now it depends on how often the 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 method actually trades, because frequently there are very, very good methods that might trade maybe 5 or 6 times a year, something like that, on extreme moves, mean reversion trades, for example. But you do need to have a decent statistical subset in order to prove that something is working. And even then, obviously, it's worked in the past doesn't necessarily mean it's going to work in the future. But I like 15 years, and if someone gives me 1,000 trades over 15 years, and then I think, okay, and it's got a reasonable curve, then that's enough for me. With the expectancy, again, I mean, you wouldn't believe what the banks are trying to shave off in terms of expectancy, because of the computers and the speed that they've actually got. They will take, what is it? Oh, when you sort of got one of those machines that slices an onion, you get this little slice of thing, or a slice of, I don't know what it is, but so thin you can almost see through it. Those guys will take that if they think they can make it work, because the market is very, very competitive. So I think expectancy is quite difficult to talk on. You certainly need to have. I mean, they say. I was trying to think of the best way to explain this. I'm more in terms of that move seems to have petered out. By the way, it's not doing it. I'm more in terms of ensuring that the observation set, if you like, is big enough. So I would prefer to have even a lower expectancy, but say a couple of thousand trades. I feel very sure, I feel very safe if I've got a couple of thousand trades. Because ultimately, as I was saying to Etienne in the beginning, the way also to turn this business round to profitability is if you sort of admit to yourself, or you say to yourself, okay, this is my sole source of income. I have to be very careful with my money here. Then you really start to do things properly because you focus. If you got another job and you think, well, it doesn't really matter if I lose a few grand here, a few grand there, the rest of it, then that's when problems happen. You start making mistakes. But to answer the question, I want more. I want a longevity of observations over a long period of time. I want to see all market types. I want to see down market, up market, side market, and then I want to see also across different instruments as well. And if something works across that, it's good enough for me. And the expectancy, to be honest, is a little bit secondary. I know that might sound a little bit unethical. It's not actually what's written in the books, but I prefer to have that longevity, that cross section of observations, rather than having something with an amazing expectancy which only trades twice a year and you've got 3 years worth of data, sort of thing. If maybe that answers the question. I've also been.
Yeah, totally right, totally right. Question from, and I want to check your time. I know we are more than an hour in,
Yeah,
but
don't worry.
maybe two last question. One from Ravindu. Are Elliott Wave still part of trading in banks, or are bankers using Elliott Wave, or not at all now?
Well, okay. Difficult for me to say what everybody's doing, but I will make dreadfully bold statements. I've never met anybody yet who has, and I don't know everybody. That's the whole point. I don't want to come across as being a know-it-all at all, but I've never met anybody yet who has made a lot of money trading financial markets using Elliott Wave. Now, I know there's this guy, Bob Prechter. I know somebody who knows him, and they have very, very deep and intellectual conversations about the wave formation. So I personally can't get it. I've never met anybody inside a bank who actually trades like that. And actually, whilst we're on that, what I also want to say, this is what I meant to say this at the beginning, just to make it clear for people. Remember, with foreign exchange, 80% of what we do inside a bank is commercial business. So, for example, when you go to the stock market, you go there to speculate. Everybody goes to the stock market. They go there to buy a stock low and hopefully to sell it at a higher price. So it's pure speculation. That's the only reason you go there. When you go to the foreign exchange market, most of the business in the banks is, BMW. They need to buy to pay for some spark plugs or something they had made in wherever it is, in America or in Japan. So there has to be a financial transaction which takes place. So the majority of the market is that's the first thing. Most of it is that it's commercial business, and they earn their money on that spread and that arranging those deals. So, for example, big banks, someone like Barclays, they're making probably about 2.5 million, about 10 million a week, something like that, just on their foreign exchange department on those commercial deals. Now, they then have other people, prop traders, so proprietary traders, who sit also in around those desks there, who will be able to take positions in their own right using the bank's money. But I don't believe that those guys are using Elliott Wave, to be honest. It could be. You will undoubtedly have hedge funds and people that probably use that, but these are very, very specialist people. I've never personally seen anybody inside the bank actually doing that. So I don't know. Hopefully that makes sense. But what is important to remember is that 80% of what happens on the bank is commercial. It's, a company from Germany needs to buy and pay for 500,000 T-shirts from China, for example. That is a transaction which has to take place. It's got to be done inside the bank, and that's actually the majority of the market is that. But that, just to finish the whole thing, that's why it is easier for us as speculators to make some money, because we can see the manipulation which is going. Well, not manipulation, we can see the price where it's moved around by the bigger traders, which they can't do in the stock market because it's too big. Everyone is a speculator there, whereas in Forex, only about 20% of people are speculating. So that's also a plus.
Interesting.
Yeah.
Question from Ari is asking, what do you recommend to go full-time from part-time to full-time trading? First thing first, Ari, we have an episode. It's interview 118 with it's another Paul, but exactly on that topic. I don't know, Paul, if you have a suggestion on how to go from part-time to full-time in trading. Anything you want to add to that?
I think the thing is, what I would say now, and this is what I was saying to a lot of people that are in my group. I've got this turtle group, and these people are professional people in their own right. We've got a guy who's, I think, a physicist. We've got people who've got companies. In a way, you can be a professional trader, but you don't actually have to give up the day job if you don't want to, because you can run the whole thing on EAs with a VPS. I have VPSs, which I think they charge me something like $35 a month for each one or something like this. I mean, the prices have come down dramatically. So the setup costs are quite low. So if you have a job, why would you want to put the pressure on yourself immediately? What I would do is get some trading systems which work, get them coded up, work out, in that coding process, work out whether that's really your time frame or not. Because sometimes you have to sort of spend money to work out whether something really isn't for you. It might be that you are really a longer term trader rather than a half an hour, 15-minute time frame trader. Work that out, get something which is working, and then at that point you could make a decision to perhaps even do what I'm suggesting, is that you get your trading slips, you present that to a trading house, or there's a lot of websites out there where they call their fund seeders. You can present your slips there, and you can get money seeded to you via intermediaries, and you can sit underneath companies who do the regulation as well. You don't even have to worry about that as well. So it could all be very, very smooth and seamless, as opposed to jumping out of a frying pan into a fire and putting the pressure on yourself, thinking, I got to make tonight the money to pay the rent and stuff like that. That's where it all goes wrong. That's in my opinion. You put the pressure on, it won't work. But if you take it slowly and you have an objective to actually manage money for other people, even if you're trading an account of $5,000, it doesn't matter. If you can put that account up 30% a year for 3-4 years, you're going to get money. You won't get a lot of money to begin with, but just bearing in mind that the average hedge fund traders, there's a lot of hedge funds going out of business. The best hedge fund traders make about 30% a year. Okay, they're dealing in billions, and then they get 20% of the profit. I mean, this is the whole point. As I come back to my first argument, you don't need to 300% your account. For example, my EAs, I target between 5 and 8% a year. That's all I need. And then if you've got money, the guys give you the money, and then you get 2% management fee, 1% management fee, plus 20% of the profits. You can make a nice living. So that is much easier, and the connections are out there to get hold of these people, the fund seeders and everything. There's a lot of people with a lot of money out there, and they're all looking for a home, and they don't know where to look. Actually, that's the other thing. That's what Forex. That's what people don't realize. They don't realize there is the money out there. Is this gigantic sums of money out there, and none of it's earning any money on the bank because of the worldwide global interest rates are just pitiful, less than pitiful. Therefore, if you can give someone 5% a year with no drawdown, then you basically you're king. And it is possible. It is most definitely possible to do it that way. So I would advise to do that. Probably keep the day job, keep paying the rent with the day job, and just do it at night time. Set your EAs up. You don't want to code it yourself. Just get someone cheap. There's plenty of people out there who want to do good coders and things, and then you can build your own little business that way and move it on like that. That's what I would say anyway.
I love this perspective. It's awesome. I think it's also the way I'm going like over time. So love it for sure.
Yeah.
Great.
Cool.
So we have a couple of questions that we have covered in the past, things like money management, things like FIB, pivot point. I think that's pretty much the same thing we've talked about. Is it possible to trade with a small $100 account, or should we have a big account?
$100, yeah. You can trade with any size account. I mean, again, if you only have $100, that doesn't really make any difference. If the objective is to produce some trading slips to show to a third party with view to them, funding you and feeding you like a fund feeder for management, then it doesn't matter. What people are looking for is drawdown. The thing that investors they hate is drawdown. You just put yourself in a position. Imagine you've got a massive company, you sold your company, you've been very successful, and you've got for your family and and for your children and your grandchildren or whatever, you've got $100 million. Let's say $100 million, a lot of money. Let's say $100 million to play with. Now, what you want to do then, because you sold all your business, you got to live off the interest, you got to live off something. At that point, you are dead scared that someone's going to lose you your $100 million. So if you give someone the $100 million to trade and they draw down to $50 million, you're going to have a heart attack, because that is your nest egg. That's your whole life that you've worked for. That's the future for your children or grandchildren or whatever it is. So, you might be prepared to take 5-10% drawdown to 90 million, for example. You start off with 100 million. Let's say 10% drawdown. Is that? Still got 90 left. So it's not too bad. So you've got to think like an investor. They don't want to have 50% drawdowns. They love a 10% drawdown. They love zero drawdown, but it's not possible because it's financial markets and you can't win 100% of the time. So think about that. But if you could have an account, if it's $100, $1,000, $10,000, $100,000, and you can draw it down, say maximum 10, 12% only, then you're in business, because that's what they're looking for. If you give them, say, 6% a year with a 12% drawdown, they'll much prefer that than give them 20% a year with a 50% drawdown. Because when they draw down 50, the phone will ring and the guy will ring up and say, liquidate everything because I want my money back. Do you see what I'm saying? There's this relationship between the drawdown and the profit. And actually, if they've got a lot of money, all they want to do is preserve that capital. They just want to grow it a little bit. And they say to their friends, I got this guy, he grows my capital 5% per year. No drawdown, nearly no drawdown. And they love it. That's how the big money thinks. And so I would even ignore the size of your account. Just trade as if you've got 100 million and you've got to protect that 100 million, and you're protecting it, with your every single power in sinew you've got in your body to protect that, in order to make sure that account is still there for tomorrow. And you can present that to someone and say, look, I've got some cracking trading slips here, will you sponsor me to trade some money? And that's the way to go, in my opinion.
Love it, love it. And I'm pretty sure that's exactly what your course will guide people to every step of the way, how to reduce drawdown, how to, first of all, create a strategy, how to reduce drawdown, how to manage money as well. So love it. Perfect. Perfect. And guys, the links will be below if you want to have the offer with Paul's course on price action plus the academy. You get 2 for 1, which is really awesome, and no price, like no increase in price, the same price as always. And that's awesome. So link below. And Paul, thank you so much for accepting to come on the channel. I think it's been awesome.
Thank you very much.
Do you have any last word of advice you want to give people?
No, just to say that, I mean, there's a lot of stuff on the internet. A lot of it is not so good as we know. It is possible to make money, but you've got to watch your leverage. You've got to have something which is proven to work. I would say for most people, try and go with the trend, because if you think about a Forex price, especially on a 15-minute chart, it mostly, I mean, just like this afternoon, not so much, or maybe this yesterday, it mostly sort of hovers a little bit. It just goes to the side, just basically goes like this, and then all of a sudden, whoosh, like this, and then it gets to that point there, and then and then back down. That's what Forex price does. Therefore, if you're with the trend, you will always be with those moves, and that's on a shorter term time frame, on an hourly or 4 hourly, something like that. And those are the ones that you want to get with if you can. And if you can train yourself to do daily or weekly or monthly, I believe you'll probably actually make more money. It'll be a little bit slower, probably. Might need a little bit more capital, but I would say go with that. But and just believe, if you're doing something and it's not working, just change. For example, are you trading with a stop? I mean, everybody should have a stop. I use, as I say, these Armageddon stops because I'm quite experienced. I've got plenty of space in between me and the market, and I got some capital. But you do need a stop just in case someone pushes a button or something happens. You must have a stop. I wouldn't necessarily put targets on so much. I know people do, but I like trailing stops. So if the market is going to run, you need to be on those moves, for example, like Brexit or one of these big moves, these election moves. You need to be on those moves if you're with the trend, and you never know how far this thing's going to run. So you get a payday. You get a really big payday. If you have a target, obviously it takes you out on your target, but then it could run on a couple hundred pips. So I would say use trailing stops to get you out. Go with the trend, and then really have a look at price action. Even if you just want to look at it online or something, just have a look at price action, because it does get you into trades earlier, and it will get you out of trades as well earlier. So that's the main thing. I think that's about it. I think for me.
Powerfully summarized in 2 minutes. I love it. Powerful, powerful. Okay. So guys, thanks so much for watching. We'll catch you tomorrow.
Okay, thanks, Etienne. Really enjoyed it.